Money Arata. Imagine the following problem. You're feeling worried about the economy and you really care about your financial future. You want to make informed decisions about your money, but you don't really understand how the economy works. The problem is that there are so many technical details that when you try to listen to someone talking about the economy, it feels like you don't have some of the basic pieces of information that you need to fully understand what they're saying. In addition to sounding complicated, all the jargon can make it really boring to listen to someone talk about the economy, especially when you're just trying to make a practical decision in your life. For example, you just want to know whether this is or not a good time for you to buy a house, or whether you should use your available cash to buy some stocks. You don't really care about all that talk related to interest rates, but you know you need to understand it in order to make good decisions. So this is why today I'm going to be explaining the economy in a way that is simple and easy to understand. So simple that even children can understand it. The reason for that is that you really need to have a solid understanding of the basics. Only after really understanding the basics, you're going to be able to make advanced financial decisions. Attention, this is not financial advice. Please read the full disclaimer before proceeding. Money has a cost. It is called the interest rate. Interest rate is the cost you pay to borrow money. Now, the economy is like a machine with different pieces and moving parts. Money printing, interest rates, the central bank. To start, you need to understand what money is. And there is physical money and digital money. Physical money is cash that you keep in your wallet. But there is also digital money. When you open your internet banking, you'll see how much you have in your savings account, how much you have in your stock portfolio, how much you have in your credit card. All of this is digital money. So when we say that the government is printing money, this is a simplification. Yes, there are actual printers that do create extra cash, paper money. But the majority of new money is digital money, and more specifically, it is money that the banks are creating when you go there and you get a loan. For example, you want to open a bakery, and then the bank examines your proposal and they might give you some credit for that. You will need to pay everything back and some more. This some more is called interest. We can also call it the cost of borrowing money. And just like you go to the shop and you can see the price that you have to pay to buy an ice cream, you can also go to the bank and check how much the cost is to borrow money using a loan. The central bank is like the big boss of all banks. And since it is the boss, it can tell what should be the price of money. So if this new money is created through loans and there is an interest, the question is how much should the bank charge you for that? The bank cannot go and create money from nowhere. The bank also needs to take a loan. And this is why the central bank enters. It is the regulator of the banking system, but you can think of it like the big boss of all banks, the bank for the banks. And guess what? When a bank goes to this big boss and asks for money, they also have to pay interest. It's very similar to when you have to pay interest to your bank in case you want to go there and request money to open a bakery. And since the central bank is the big boss, it can control how much it charges for this interest rate. If the interest rate is high, it's going to become more expensive for banks to borrow money and then be able to lend it to customers like you. Okay, so what? Well, think about it. If the interest rate is the price of borrowing money, and if the interest rate is high, this means that now it's becoming more expensive to borrow money. And the result is that there will be fewer people like you going and taking loans, and all of that can slow down the economy. See, when the interest rates are high, the economy slows down. People produce less, they consume less. And when the interest rates are low, it is the opposite. So let's get back to the example of opening a bakery. You would be doing your calculations and you see that the interest rates are too high. So you realize that your plans of opening a bakery basically will not work. You're not going to be able to make a profit that is decent enough to pay back the bank, and then you just don't move ahead with your dream. And the consequence is that Your neighborhood will not have that new bakery that you're planning. You will not be creating new jobs. Also, you're not going to be buying flour and sugar on a regular basis and so on. Do you see how this slows down the whole economy? Now, think of the opposite. If the interest rate is low, it's going to be cheaper for banks to borrow money, and they also might be better able to lend more to customers like you. And suddenly it is easier to open bakeries and restaurants and factories, all types of businesses. There will be many new jobs, new products, new services. All these entrepreneurs will create a lot of jobs, and they might even compete among each other to recruit workers. And when there is a lot of competition, they might even pay higher salaries to get the right workers who will then make more money and they can also spend more. This can make the economy grow. Sounds good, right? Not so much. We need to understand what happens if things get out of control. Since the big boss is the central bank, who can tell what's going to be the interest rate, this can have a big impact on the economy. If this is not managed well, it can cause bubbles of speculation and inflation and spectacular crashes when the bubble pops and brings a long and painful recession. If interest rates are managed well, there will be basically natural cycles of expansion and contraction in the economy. But there is always a risk of bubbles. Remember that the economy is a machine with many pieces, and there are many other economic and political factors that can also contribute to the changes in the level of economic activity. But we'll continue explaining here in a way that even a child can understand. Inflation is a monetary phenomenon. There's too much money being created. And since money is mostly created with loans, the interest rate is at the center of everything. The central bank can adjust the interest rate to avoid extreme periods of contraction or expansion. In general, the central bank can raise the interest rates during these periods of strong economic growth in order to cool down the economy and prevent overheating and inflation. By raising interest rates, the central bank makes borrowing more expensive, which can then discourage borrowing and spending and slow down the pace of the economic growth. Now, on the other hand, during periods of economic weaknesses or recession, the central bank can lower interest rates in order to stimulate economic activity. Then lower interest rates make borrowing cheaper. So then it makes an incentive for people like you to go ahead and borrow and spend, help to stimulate the economic growth. Sounds easy, right? Oh, not so much. Now the question here is how much to raise or lower and how fast to do it. If this is not done well, it can lead to crashes or bubbles. You need to understand economic history to understand what's going on right now and what will happen in the future. Right now, we're in a moment of transition. We just had an overheating because of the excessive reactions during the recent global health crisis. But eventually, our economy will enter a stage of weakness and recession. Some might suggest stagflation, as we discussed in the episode number 35 of the Money Arata series. If the central bank lowers interest rates too slowly during a period of economic weakness, they might fail to stimulate the economic growth and they could lead to a prolonged period of stagnation. Now, on the other hand, if the central bank lowers interest rates too quickly or too low, it could lead to excessive borrowing and spending, leading to inflation or even a bubble in asset prices. If the central bank raises interest rates too slowly during a period of strong economic activity, it just might not be enough. Then the economy might overheat, leading to a bubble in asset prices. Some people say that this is what happened recently when you saw that prices of stocks went too high. If you understood it, you could have bought some stocks because you would know that it would keep going higher and higher and higher because of the low interest rates between the years 2020 2021. On the other hand, if the central bank raises interest rates too quickly or too high, it could cause a recession or a financial crisis. The Federal Reserve, also known as the Fed, is the central bank of the United States. And in the 1980s, Paul Volcker, a former Fed chairman, aggressively raised interest rates in order to combat the high inflation of the early 1980s. All Volcker's policies to fight inflation were successful in reducing the price levels, although it resulted in a recession and it caused a spike in unemployment. Despite that, many economists think that these sacrifices were necessary in order to secure price stability and long-term growth in the economy. It was bitter medicine, but the patient needed it. Volcker's decisions had a lasting impact on the US economy. They're still seen as a major contributor to the period of economic stability and growth that followed. Decisions of the Fed can have a huge impact on the economy of the planet. The Fed is responsible for implementing monetary policy in the US. This includes setting the interest rates. However, this can have an impact on the global economy. Take a look, for example, at the exchange rate of the US dollar. The US dollar is the world's reserve currency, meaning it is widely used as a medium of exchange and as a store of value in international trade and financial transactions. We explained all of that in detail in the episode number 20 of the Money Arata series. Changes in the value of the US dollar can have a major impact on other countries' economies as well as the prices of goods, commodities, services that are being traded internationally. You can measure the value of the dollar using the DXY, DXY dollar index. This is a measure of the value of the US dollar relative to a basket of other major currencies. When the Fed raises interest rates, it can make the US dollar more attractive to foreign investors, leading to an increase in demand for the US dollar and a corresponding appreciation of the currency. This can make the US ports more expensive and the imports cheaper, potentially impacting the trade balance and the overall level of the economic activity in the US and other countries. On the other hand, if the Fed lowers interest rates, it can make the US dollar less attractive to foreign investors. So if fewer investors want dollars, this will lead to a decrease in demand for the US dollar. Therefore, it will dump in price. Okay, so what? When the dollar falls, the price of commodities tends to go up. And also, a fall in the interest rates of the United States tends to increase global inflation. This, in turn, encourages central banks in other countries to increase their interest rates, which causes a pressure for a bigger fall in the dollar and therefore new waves of increase in commodity prices. That's why sometimes the Fed doesn't see cutting interest rates as a viable option during moments of crisis. Also, with a cheaper dollar, this can make it easier for Americans to export because their products will be cheaper. And also, it makes importing to the US more expensive. So this all has an impact on trade balance and the overall level of economic activity in the US and other countries. Well, what you need to keep in mind at the moment is that more and more we're going through a process of deglobalization, as we explained in the episode number 33 of the Money Arata series. When you understand the basic indicators of the economy, you can make better informed decisions and you can have a better life. So now it should be clear how interest rates can impact your financial decisions in a number of ways. Imagine you're thinking about borrowing money, such as taking out a mortgage to buy a house or a loan to start a business. Higher interest rates will make borrowing more expensive, while lower interest rates will make borrowing cheaper. This can impact your decision about whether or not this is the right moment, as well as the terms of the loan that you choose. We also have to talk about the real negative interest rates, which refer to a situation in which the rate of return on a low-risk investment is lower than the rate of inflation. In this situation, the purchasing power of your money would be eroded over time, even if you're earning a positive nominal rate on your investment. This is one of the reasons why we say that inflation is the perfect crime to steal from you, as we already discussed in episode number 3 of the Money Arata series. For example, if the rate of inflation for your cost of living is around 20% a year, and the best interest rate that you can get on a low-risk investment is 10%, this means that you're earning a negative interest rate of 10%. In this situation, the value of your money would be decreasing at a rate of 10% a year even though you're earning a nominal interest rate of 10% on your investment. In general, real negative interest rates can make it less attractive to save money in low-risk investments, as the value of your money is likely to decline over time. Instead of that, you might be more likely to consider investing in higher risk investments, such as stocks, certain types of real estate, in an effort to earn a higher return and maintain the purchasing power of your money. It is very important to carefully evaluate the risks and the potential returns of different investments, and also to consider your own financial goals and your risk tolerance whenever you're making financial decisions. I promise that the explanation here would be easy enough so that even a child could understand it, so today we're not going to go any deeper. But when you really understand the problem of the negative interest rate environment and that the official government inflation index, the CPI, is not the real inflation, then you really start to open your eyes. But that's going to be a conversation for another episode. Money is a powerful tool. With the knowledge of how it is created and the impact of interest rates, you can make better use of your money. By understanding the basics of how money is created and how interest rates are managed, you can make better informed decisions and you can plan for your future. Specifically, you can take advantage of both expansion and contraction cycles. You can protect yourself from the risks of financial bubbles and also build a secure future. There's so much to talk about, there's so much to learn, and that is why I want to invite you to subscribe to our Arata Academy channel, and particularly take a look at our playlist of the Money Arata series. And also, you can always check our masterclass at arata.se/diamondhands.